Markets soar, markets crash, and headlines scream louder every time. But as an intelligent investor, what should you actually do when the prices swing wildly? Benjamin Graham, the father of value investing, answered this clearly in Chapter 8 of The Intelligent Investor, and his words have never been more relevant. Chapter 8 isn't just theory, it's a survival guide. Graham didn't predict every crisis, but he taught how to navigate any crisis. The lesson? Control your reactions, not the market. Graham starts with this. Price swings are not a bug. They're a feature. Stocks rise and fall. That's what they do. Short-term bonds may remain steady, but equities will test your nerves. The intelligent investor is mentally prepared and financially equipped. Tempted to speculate? You're not alone. But speculation is not investing. It's gambling. Graham said, if you must speculate, do it with your eyes open, and only with money you can afford to lose. Speculating with your retirement fund is like betting your life jacket in a storm. There are two reactions to market chaos: timing and pricing. Timing is seductive. Try to buy low, sell high. But pricing is smarter. Understand what something is worth, then buy it when it's cheap and hold until it's not. That's value investing. Think experts can time the market? In 2000, tech was unstoppable until it wasn't. In 2008, banks were too big to fail until they did. Forecasting fails because it assumes markets are rational. Graham reminds us, markets are emotional, not predictable. The real threat isn't a bear market. It's following the crowd. When everyone's euphoric, prices inflate. When fear hits, they plummet. The intelligent investor is not immune to emotion, but they're disciplined enough to act against it. Buy low, sell high is great in theory, but in real time, it's chaos. It's easy to buy when prices are rising, harder when they're falling. History shows those who held quality assets during downturns without panic won in the long run. Graham studied strategies like the Dow Theory and formula plans. They worked until too many followed them. Popular systems attract crowds, and once everyone jumps in, the edge disappears. That's why Graham advises flexibility, not formula. Instead of rigid systems, Graham preferred a flexible allocation model. Adjust your balance between stocks and bonds based on valuations, not headlines. This is how investors like Warren Buffett manage risk without emotion. Graham's biggest insight: the market isn't your main opponent. You are. Greed in bull markets, fear in bear markets, regret, overconfidence. Your real edge is emotional mastery, the ability to stay rational when others aren't. Volatility is short-term noise. Graham reminds us, real value reveals itself over time. Like planting a tree, you won't see the shade today, but decades later, you'll be thankful you did. From Warren Buffett to Howard Marks, the greats repeat Graham's advice. They're not market timers. They're value seekers. They build wealth not by being clever, but by being consistent. If Graham were alive today, he wouldn't be surprised by crypto, meme stocks, or panic selling. He'd just repeat his core message. Focus on value. Be disciplined. Ignore noise. Think long-term. Start simple. Know what you own and why. Review your allocation annually, not daily. Use volatility to your advantage. And above all, protect yourself from yourself. Markets will always move. But if you move with purpose, not panic, you'll come out ahead. In Graham's words, the investor's worst enemy is likely to be himself. Be the intelligent investor. Invest wisely.